From New York City for our viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, the U.S. government shutdown enters its 10th day with no end in sight, further delaying critical economic data as we approach the Federal Reserve's October policy meeting. Tariff concerns rattle markets as President Trump ramps up tariff threats against China. And the recent bankruptcy of auto parts supplier First Brands is revealing cracks in credit. We're going to get DoubleLine Capital's take on what this signals in just a moment. But first, we begin with the big issue, the lack of official economic data clouding the economic picture.
Well, with this shutdown, the Fed really is flying blind.
We're definitely dealing with less information, but we're not flying blind.
In the absence of data, people seem to be perfectly happy.
It's amazing how well the economy does despite Washington.
The economy can change on a dime here.
The bigger macro picture is getting more confused.
What's really important is the volatility of inflation.
I'm not sure that the Fed can fully ignore what's going on with inflation.
We just don't think treasuries offer compelling value here given this inflationary risks.
It's very important that the Fed stays focused on that mandate for price stability, even with early signs of a cooling in top-line hiring.
The slower the Fed goes up front, the bigger the risk is that they have to do a little bit more later.
Well, I think they cut again, in part because they may not get any more official data.
No data means more caution.
The risk to look for right now is, can the Fed cut rates as much as the market is presently anticipating?
The Fed is likely to cut. The economy is likely to grow.
And those headlines last hour from President Trump on China and tariffs are reminding investors of trade risks still in the markets. You look at the dollar, it is weakening a bit in the session today, but if you look at it over the past 5 days, it is still set for its best week since early August, extending that recovery off its lows in mid-September. Now, here's a look at the debasement trade that a lot of people have say are taking over markets right now. And this is through ETFs. The biggest gold fund is GLD, and it's in yellow, appropriately enough. It saw assets rise almost 80% in the past 12 months to $131 billion. That's compared with the two biggest Bitcoin ETFs, which is the white line here. Their combined assets are up 272% to $122 billion. Bumping along the bottom of this chart here is the green line, and that is TLT, the largest long-duration Treasury ETF. Its assets actually dropped 16% to just under $50 billion. Ken Griffin of Citadel sees gold's record run and says that investors are actively looking for ways to effectively de-dollarize or de-risk their portfolios as excessive stimulus stokes markets and drives what he calls an economic sugar high. Now, all this mixed economic messaging has JP Morgan Chase's CEO Jamie Dimon ready for basically all outcomes.
We're in a bull market. It's been clear. Asset prices are high, credit spreads are low, consumers still okay. So far, so good. There are a lot of issues out there that the economy's got to deal with, from all the geopolitical stuff. Maybe they'll sort out well. What's going to happen to inflation? I'm a little more nervous about inflation not coming down like people expect. I hope for the best, plan for the worst.
And you're not worried about a recession in 2026 for the U.S. You made that clear.
I think it could happen in 2026. I'm not worried about it as a different statement. Markets have to make a forecast. I want to point out that forecasts have almost always been wrong. And the Fed's been wrong too. If inflation goes up, starts ticking up for whatever reason, and it might, it's going to be hard to do 100 points. If unemployment starts going up, well, obviously they're going to do some. So we'll see.
Let's dig into the macro backdrop here with Jeff Sherman, Deputy Chief Investment Officer at DoubleLine Capital, joining us from California. Jeff, fantastic to see you. You heard what Jamie Dimon said, and like the Federal Reserve, the bond market is pretty much divided between worrying over a slowdown in the labor market, dragging the economy south, versus fear of inflation due to tariffs reigniting at some point. What's your view?
Yeah, I mean, we're sitting at the crossroads here, too. And I did a webcast this week, and I titled it Labor at the Crossroads, because so much focus over the last couple of years has been on the inflationary impact and the Fed's response mechanism to that. And the bond market, I remind you, over the last 3 years has been very wrong on Fed policy. That is, they were very slow to acknowledge the rate hikes, and then further really pressing the string of trying to get rate cuts sooner than possible, or sooner than the Fed would actually respond to. And so here we are again at one of these crossroads. And I think what Jamie Dimon said is right, that, if there's some pressure on the inflation data, maybe the Fed's a little more hesitant to do anything. But if we see degradation in labor, they know that mechanism they need to really stave off quite quickly. And so what we're seeing here is this very strange equilibrium within the labor market. And what I mean by that, and Jay Powell acknowledged this 2 press conferences ago, was saying that ultimately, we're seeing the demand for labor come down. That's job openings coming down. But also what we've seen is the supply of labor coming down. And in some ways that's related to the immigration policies as well. So when you put this together, it's really a tough time for the Fed. And then as you led into that Jamie Dimon talk, all I heard about was the uncertainty with lack of economic data. And we still get data, we just don't get a lot of the government data. And it appears to me that so far that, with the Fed at the last meeting giving the risk management cut, it seems that they're going to try to go that direction one more time. But I think they really want to be sensitive to the incoming data and really focus on the labor market. So I think it's probably a done deal for another cut. The market has 2 more cuts at the subsequent meetings or the rest of the meetings for the year. But I do think that, maybe that December cut maybe doesn't come through as much, depending on what the data looks like. So as always, here we are once again, data dependent. The difference here is we don't really have a lot of data coming through from the government side.
Absolutely. What we do have, though, are threats, generic, vague threats, in this case on China and massive tariffs. How do you think about that as you consider the inflation outlook? We were showing a chart earlier about how inflation has pretty much stabilized, but well above that 2% target the Fed has identified.
Well, it's very important, Scarlett. And when you think about the inflation data, if you dig into the pieces there, what you've seen is core goods start to contribute positively to inflation again. And, over the last 15 years or so, it's primarily been a drag on inflation. And so some of that is the tariff policy coming through. And secondly, what I'd like to point out on the tariff policy is that we've seen the administration rave about how much revenue they've generated in the last 30 days or so based on the tariff policy. And so I think the run rate right now, if you analyze the monthly data, is around roughly $350 billion. And so what that tells me is that not necessarily we've had a successful policy yet, but ultimately the inventories that are being built today are predicated on this new tariff policy. And so what that is the already announced tariffs. Now we've also seen pharmaceuticals come in the mix. We've seen recently home furnishings. Now there's the threat of China again. There's semiconductors again. So this is the ever evolving kind of tariff roulette where no one really knows what the policy is, but we do know that we do have these baseline tariffs. And so I think it's too early to say that the inflation's been contained off of the tariff policy. And I think we're just starting to see the semblances of it. Now we're going to get, third quarter earnings coming up. And unfortunately, I don't think you're going to see a lot of that tariff pricing in there yet, whether or not it's being absorbed at the margin level, where it exists in the supply chain, or if it gets passed to the end consumer. So bringing this all back together, I think the jury's still out for the next 3 to 6 months on whether or not we're going to see these inflationary impulses. And I think that also puts the Fed in a more cautious position. Though I agree with Mr. Dimon on if there's degradation in labor, they will move quickly.
Okay, well, that lack of visibility is showing up in how investors are positioning themselves. There's the debasement trade, the stampede into gold, into silver, into Bitcoin. To what extent do you see the global bond market supporting or backing up that debasement trade? Because, for instance, the 5-year break-even rate in the U.S. remains unchanged and kind of close to the Fed's 2% target.
Yeah, that's the weird thing about the break-evens and the inflation linkers market here in the U.S. is that there's been this eerie sense of stability and confidence in that 2% target. And I don't like that part of the curve when we talk about trying to buy tips. In our shorter duration portfolios that we run, we've been buying shorter duration tips because we think there was some optionality, especially when break-evens really dipped on that 2-year point early in the summer or late spring. And so when I look at the debasement trade, what I also look at is the 30-year bonds across the developed world. And what you've seen there is really a rejection of investors trying to step into that, even when there's this perception of a Fed cutting cycle. And so I think the idea that, the policies here are not really U.S. friendly, they're not dollar friendly. And if we're going to continue to, kind of put pressure on the dollar, it's going to put some inflation in the U.S. as well. But the developed world suffers from a fiscal overspending, and that's what's being reflected there as well. And so I think the debasement trades make a lot of sense here, Granted, they have a lot of momentum at this stage. And as you mentioned, silver in there, silver hadn't been part of the discussion until the last few weeks. But ultimately, I think there's a lot of investors looking around saying maybe the strength of the U.S. dollar has been overdone. And by the way, the dollar has been overvalued, whether you look at real effective exchange rates, trade weighted basis, purchasing power parity. It's been overvalued for almost a decade now. So probably it's time to get some more stability in there and bring the dollar down. And I think that's what you're seeing reflected there.
All right, Jeff Sherman of DoubleLine Capital, he is sticking with us because up next we've got the auction block. After a sizzling September, October, pretty much off to a slow start for credit sales. Earnings blackouts, the shutdown, and uncertainty caused by the likes of First Brands causing maybe a bit of a pause. This is Real Yield on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the auction block, where we look at the highlights for debt sales this week. And we start with treasuries. There were sales for the 3, 10, and 30 years. Of note, there was a record low share of 30-year bonds awarded to primary dealers. The 10 and 30 years also both tailed slightly. Moving to credit and U.S. investment grade, the shutdown and earnings blackouts limiting issuance this week, with just 3 deals sold in the past 3 sessions. Top sales included TD Bank and T-Mobile. Deals might get jump-started again after next week's bank earnings. And in high yield, a similar story with a slowdown in the pace of sales. October has so far only seen around $4.25 billion worth. Junk bond rally appears to be faltering. The group is headed for its biggest weekly decline in more than 4 months. Now, when it comes to credit, all the talk has been focused on First Brands, the auto parts supplier, and if its demise will widen to the rest of credit. Even Devitt of Moneda says it does give her some pause.
There was such a rush to put capital to work, such a thirst for yield, that there really was disregard for basic due diligence. And it's true that these may be de minimis amounts on the balance sheets of these banks that are looking pretty safe, pretty secure relative to how they looked in 2008. But that's still no excuse for shoddy due diligence practices. And I think if we see it here, it's pretty clear that it's not only going to be just here. So there may be this growth, which allows us to kick the can down the road when it comes to the default cycle. But what does worry me is that clearly when so much capital is chasing a tight area, a crowded area of returns, there will be I's that are not dotted and T's that are not crossed. And that's clearly what happened here.
Let's bring in our roundtable on the credit market. Joining us is Amanda Lynam. She is head of macro credit research at BlackRock. And still with us is Jeff Sherman, deputy CIO at DoubleLine Capital. Amanda, let me start with you because I know that you can't talk about First Brands directly, but it is the talk of the credit market this week. When it comes to the fallout, no one really knows how far and wide it goes. Our credit reporters are saying that the fallout does seem to be broader than other bankruptcies in the past. I just wonder, is this a reminder of how there are still a lot more issues in leveraged loans than perhaps people had priced in or anticipated?
Good afternoon. Thank you for having me. I would actually take a slightly different stance. Our view is that the peak in corporate credit default activity, which has been building actually since the Fed started hiking rates in 2022, is likely behind us, driven by a combination of supportive enough growth, companies' resilience in navigating this backdrop, and I would say a solid starting point for fundamentals. And so the key question for investors is peak trade policy uncertainty behind us? What is the growth backdrop looking like? And will corporates continue to navigate with this resilience? Again, we've already seen a pretty significant uptick in defaults. It's largely been confined to, for example, smaller issuers, repeat borrowers, loan-only capital structures in some instances. It hasn't been enough to derail overall performance. The trend of dispersion, though, and episodic market volatility is alive and well. So that reinforces the importance of credit selection, underwriting, due diligence. But I think from a broad risk posture, is it enough to warrant an overly defensive stance? We don't see it. That said, there will be dispersion under the surface. We're no longer in a rising tide lifts all boats environment. But again, the key, our view is that the peak is probably behind us at this point.
I hear you about the dispersion, but we see that cash is still pouring into credit and spreads are tight. How much complacency is there in credit?
I don't think there's a degree of complacency because you actually still see the left tail pockets of the market lagging the overall tightening of the index. So you can see that in investors pushing back to a certain degree on spread levels and valuations, which is healthy. Our view on credit is if you're allocating to credit, you should be allocating for carry, for income, and for yield, not because we think that there's scope for spreads to move materially tighter, and not because we think think rates are going to fall dramatically either, which are historically, as you know, the drivers that boost total returns in some market cycles. So for our perspective, it does feel like there's a bit of indigestion. It feels like we're hitting a speed limit a bit, but I don't feel as though much has fundamentally changed about the backdrop in corporate credit. And again, these periods of episodic market volatility, if we take it kind of the natural extension for market functioning, probably opens the door for areas like private credit to step in and fill a financing void in those sorts of episodes.
Jeff, I want you to jump in here and get your take. Do you think the First Brands blow up was indigestion, or could it be something more?
Well, I think it's emblematic of excessive risk taking. I mean, that's really what this embodies here. And we can blame due diligence, we can blame massive concentration, but at the end of it, this is what happens when people chase yield. And I think what Amanda points out is right, is that when you look at the public markets today, and I think Apollo put this out this morning saying 90% of the credit markets yield inside of 5% today. But, and then that's an aggregate globally. But if you look at kind of what's happened in the high yield market and the loan market, it's what the safety appears to be the double B and single B. But when you get into triple C assets, then that's where you start to see the double-digit yield. So there's this huge gap between, let's say, single B and triple C assets today, where the market is rejecting some of these kind of riskier type of products. And so this is what happens when you never thought we were going to be talking about a spark plug manufacturer and someone who creates like windshield wiper blades is going to bring down the system. And so I think this is just emblematic of people chasing yield. There's been this fervor for private credit. Loans are something that feeds that system as well. And so I think what you're seeing is some of this reckless behavior there. So is it contagion? It's too early to say that that's the case. There's some big numbers here, but they're absorbed in larger funds. But I think it's emblematic of the risk-taking environment that we've seen over the last year or so.
Amanda, there is an argument that if there are blowups in leveraged loans like at First Brands, things could be worse in private credit where the borrowers can be weaker and tend to have to make bigger debt payments. How do you respond to that?
Well, I would say actually in the past few years, even especially since the pandemic, we're seeing a lot more fluidity across the borrower spectrum where the same borrowers are tapping public and private credit markets. So in many instances, private credit is not reserved for niche financing situations like it was in the earliest days of its asset class. We actually think that private credit's ability to step in during periods of episodic market volatility and public debt markets is a net positive for providing funding access. And actually, fundamentals have been holding up really well in private credit. We've seen improvements in interest coverage. We've seen the strongest EBITDA growth in 5 years using the Lincoln International Index. We've seen contained realized losses. So I think really there that kind of underwriting, structuring, due diligence is a value add in terms of taking credit risk. And I would push back against the idea that the borrower cohorts are significantly different because, again, we're seeing more fluidity across those markets.
Jeff, what about you? What's your take?
Yeah, I mean, the private credit market exists for a reason. It's a company that needs time to work it out. They don't need to be marked to market. And, they're a bad business and needs to be restructured typically. And so from that standpoint, it does make sense as a risk taker if you can do the underwriting diligence and be able to do it. But when there's so much capital chasing an asset class, that's where, again, the sloppiness happens in the credit markets. And I think the bank loan market has been really kind of the center of some of this for the last couple of years because that's where interest rate policy has been impacted the most. It's typically floating rate debt. Rates have been high there where, the high yield market was able to term it out. And so I think what you see about the private credit market is that it has a place in the overall market, but it's not the answer to, just a bad company out there. You have to be able to restructure and get through it. So all in all, I'm cautious on the private credit because the convergence of yields to the public sector markets. And when I see deals out there in the private markets that yield in the high single digits, it doesn't really get me excited when I know equivalent risk exists in the public markets at a higher yield as well. So we remain somewhat cautious on it. But again, I don't think it's an imminent implosion because of how much capital is there.
I want to switch gears and look at investment grade for a moment, Amanda. TD security strategist Hans Mikkelsen says that some investment grade spreads could go negative over U.S. Treasuries, which means that debt issued by AAA companies like Microsoft are seen as a safer investment or bet than U.S. Treasuries. How broad is this group of very high quality corporate debt that is just as liquid as Treasuries?
Sure. So there are only a handful of corporates that are AAA. When I started in corporate credit many years ago, there were more. But I think over time, corporate CFOs and treasurers understand that they probably don't need to be at the highest end of the rating spectrum from a cost of capital standpoint. They can be lower, but still within the comfortable territory of IG. I would push back on the idea of kind of parsing the negative spreads, because of course it matters, not to get too technical, where on the curve you're priced, where you're matching. I think the general theme, though, is IG corporates probably have a lot of debt capacity to continue to add debt to their capital structures and stay comfortably within that IG territory. So for choice within IG, we actually like moving down in quality, really focusing on that BBB pocket of the market, because there's less scope for balance sheet deterioration. You're picking up some additional spread, but still really fundamentally high credit quality. Even the high end of high yield looks more similar to investment grade these days in terms of some credit metrics. So for sure, there's a lot of market segmentation, probably doesn't get discussed enough, but very comfortable with the low end of the quality spectrum, even in IG.
All right, Amanda, thank you so much. Amanda Lynam of BlackRock and Jeff Sherman, our thanks to him of DoubleLine Capital as well. Really appreciate both of you joining us today. And if you can't get enough talk on credit, please check out the Bloomberg Credit Edge weekly podcast on the Bloomberg Terminal and wherever you get your podcasts. Still ahead on Real Yield, the final spread. The week ahead, the BLS is vowing to get us a read on inflation before the next Fed meeting at the end of this month. This is Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up on Monday, the IMF World Bank hosts its annual meetings. They begin, and the U.S. bond market will be closed for Columbus Day. Let's move ahead to Tuesday because we get commentary from Fed Chair Jay Powell and earnings kickoff for the big banks, JP Morgan, Wells Fargo among them. On Wednesday, we're going to get more bank earnings from Morgan Stanley and Bank of America, plus the release of the Fed's Beige Book, which takes on extra importance because it's anecdotal and will get released in the absence of economic data. On Thursday, our Lisa Bromwitz will be interviewing Christine Lagarde, the president of the ECB, as part of a panel, and we get the Philadelphia Fed Business Outlook. Looking ahead to Friday, we've got Alberto Musalem, the St. Louis Fed president, sitting down with our own Mike McKee right here on Real Yield. And for my final thought, one big data point we were supposed to get next week was CPI, but due to the government shutdown, it will be delayed by 1 week, and we'll now get it on October 24th, the Friday before the FOMC meeting.